Well, hello folks, I'm L.A. Little and this is your weekly NeoTA wrap. We take a look at these markets and we do it from a neoclassical perspective. Each time asking ourselves what happened this last week and what does it tell us about the coming ones. I do this show every Sunday night, broadcast at or before 10 o'clock Eastern Time. Archived on YouTube, it's under the channel L.A. Little. You can catch it there each week, along with the daily wraps Monday through Thursday, and then of course the other videos that we do for members and for users of the site. So if you haven't checked it out, check it out, subscribe to it, get it automatically. You'll be updated each time there is a show. Let's turn to the numbers, see what happened last week. It was a down week on the NASDAQ. S&P's eked out a gain, so did the Dow, and the Russell was actually the leader last week. Not huge moves, but moves higher nonetheless. If we pop over and take a look at the charts, what you're going to see here is that the Dow actually moved higher. This is on a weekly, and that was after it kind of stalemated there last week. Volumes, of course, pretty low here. But if we pop over to the S&P, if you remember last week, the S&Ps actually had, on a weekly basis, and let me just pull the weeklies up by themselves. On a weekly basis, we had the S&Ps do a 2-bar reversal, if you remember. That gave us a little bit of pause, saying, okay, that's the first one of these we've seen on a weekly. No problem. They just come in and buy it. Yes, we were down on Monday off of that, but by Tuesday, Wednesday, we kind of inched back up. We ended up with a gain for the week, so not exactly a sideways move when it should have been. Okay, so what do we know about what happens, what we think should happen, and what actually happens? We use that information to tell us what the market's saying, and the market is saying, hey, I'm stronger than you think, and it's been saying that for a long time, and that's what it continues to say. Now, if we move over and look at the NASDAQ and the NDX, these guys are stuck. They're stuck up underneath. They had more volume last week. The low the prior week was 47.23. The low this last week was 47.24. So they didn't test the low. It's an inside bar, a little bit more volume, and if we pull over and look at the dailies on this, we see that breakdown bar off December 1st. That bar had about 18.9. We're going back up with 17.6. We got over, back under. We're still under that bar. Haven't been able to get over it. So that bar still stymieing the broad NASDAQ. And the real weakness inside that is in the big caps. You can see it here where the top is 43.32 on the NDX. We've only been able to get up to 43.24, so that's where the weakness is. That's stocks like Apple, Google, Microsoft, Oracle. All of those stocks are struggling, the big cap. That's got an inside bar here, a little bit more volume as well. This week, if you're watching something this week, you want to know where the market's going, watch the large cap technologies. If they start to move, the whole market's going to move again. If they still are stymied and they can't get over that high, then maybe we're finally going to get a retrace. Again, as I've said, we can get a retrace at any point. Is there anything to tell us that we're going to get one? Still isn't. Hasn't been, still isn't. We're still waiting. No sign yet of a retrace coming. So that's where things stand on the indexes. If we look at the Russell, on the weekly, the Russell is right up there testing that high now. It's set the stage. It's 5 weeks. It's been going sideways up here after the big run. That usually is consolidation. In the old classical sense, this is a flag formation. So essentially you come up and then you have this flag up here, and that's kind of what you have, set up here. Usually those flags, essentially you get consolidation before you break out farther, and this one wants to break out and test these highs up here. Of course, it's got to get over this one first. So if you're watching next week, you want to see this one break over and hold. and you want to see the NDX NASDAQ break over and hold as well. If you look at the sectors strong all across the board. I mean, the only thing that's weak in terms of the major sectors is the energy. We'll pop that one up first. Even here, it's still holding a higher high with respect to that low. You had more volume last week, so you really don't have the kind of reversal setup you want. If you look at some of the subsectors, the OIH, for example, has broken down, so you can see the weakness is in the drillers themselves. So, you know, when you're looking at sectors, that's the weak one. If you look outside of that, you've got plenty of sectors that are still pushing new highs. The SOX, the chips themselves, new highs, stretching. XLF, new highs, stretching. XLV, same thing, stretching the new highs, and inside that you've got the biotechs doing the same thing. So, you know, when you look at this, it's pretty hard to be bearish. You've got a preponderance of evidence suggesting that this market isn't done. It's been suggesting that for quite a while. It continues to suggest that. Until it does something else, you just got to believe it and you got to stay with it. If we look overseas, remember Europe with Draghi, they did not do anything with respect to the easing that people were wanting. Sold off for one day, and then what did they do? The DAX powers up, breaks the highs. So the DAX now has actually broken 2 new highs. That's 7-year highs, folks. You know, that's not as if this thing is hurting, even though we know Europe is on the cusp of a recession. You know, how does that figure? You know, how do you get new highs when you're trying to go into a recession? Well, you get it because the central banks allow it. Central bank in China allowing it. The central bank in Japan allowing it. That's how you get new highs. That's how these things keep pushing to new highs. And if you don't believe it, just look at the charts. Who's doing the best? Who's pushing highs? It's those countries where their central banks are active. And then it's ours, you know, doing the same for a different reason, which we'll highlight here a little bit in tonight's spotlight. So overall, it's hard to be bearish. You know, the worst thing you can say about this market is that there are some, you know, problems underneath the covers, so to speak. You know, we've talked about the UUP, for example. This has got an ABCD structure going to the top side. That ABCD structure, though it looks pretty high here, if you're doing percentages, right, it only moves it up to about there. So we don't have that much farther to go. But you can see it's a steady rise, and that, if it continues, right, that puts pressure at some point potentially on the world markets like we saw back in September. That's something we keep watching, but right now there's no evidence of issues. If we look at the bonds sold back down a little bit. They're suggesting, you know, they had a little bit more volume on the top side. They're suggesting that they're in a holding pattern before they get back up to those highs. And so that gives equities more room to rumble, so to speak. And there's a lot of noise about, you know, whether or not the big drop in oil that took place, you know, is going to crush this market, so forth. You know, in the short run, how can you think oil is going to cause problems when gas is going down like it is and put more money in people's pockets? You know, it's got to help initially. Now, it could be that you're going to get a wave of bankruptcies if it stays down here, but that comes a little bit later. That doesn't come off the bat. In other words, the first thing they'll do is they'll start shuttering some of their unprofitable wells, and they'll start moving, you know, that equipment to wells where they can get more profitability. In other words, the ones that are the cheaper to operate, but they'll keep pumping. Now, if oil doesn't come back and you're 2, 3, 4 months down the road here, you know, then you potentially can start seeing some bankruptcies and, you know, some people having to shutter wells. And at that point, yeah, then it can start affecting things, right? It can start affecting the banks that have made those loans. You know, I would think Texas is, of course, an all bust boom state. I wouldn't be surprised to see it hit there. Wyoming, Colorado, there's maybe even North Dakota. That whole mid section of the country where most of the oil is drilled, and then in Alaska too, those are the places that are going to probably get hit. Gulf of Mexico maybe. But that still is down the road. It's not right now. So oil right now, I think, is more of a boom than it is a bust initially off these lower prices. If we try to do a synopsis here real quick, it's the same story. It's the same story as it has been, and that is that there's very little to suggest this market is going to pull back in any significant way. And if it does pull back, it probably is going to set up some sort of a buy the retrace type trade versus get worried and get out. So I don't think that one should be extremely worried about that condition or that potential. The ABCD structures are still in place to take us higher, and the bullish forces are still in control everywhere I look. So that's kind of where we sit tonight. It's pretty much the same story we've had, and as long as it stays that way, we'll keep reading it that way. I got a viewer question one tonight, and then we'll go to the spotlight. Let's take the viewer question first. It has to do with the banking stocks. The notation here is the XLF, the BKX. They've broken out, and they're pushing higher. And then the stock that was in the spotlight was Citigroup. And the question here is that Citigroup has broken out. It's broken over this swing point high. It actually broke two. It broke this one and that one. And the question is will this thing retrace and give you an entry at a lower price? Well, it may, but it may not. And the reason for that is it's broken on multiple time frames, multiple swing points. So you have a break here on this time frame. This is the daily chart. You have the two breaks, and let me just circle these. You're breaking this swing point high, you're breaking this one as well on this move. So you have a big, strong move, and you have it happening on multiple time frames. And folks, it's not just here. If it continues, it's also on the monthly. The monthly's breaking as well. So this is a potential, jugular type move that could just keep going. And so is it going to give you a retrace? These are the types of moves that have the potential to just keep going. So if this does come in a little bit, and you want to get involved, that's probably what you want to do. Your retest, regenerate is this zone, so you have to realize that. But if you get anything back into this area, you have to take it. And if this thing starts to move away from you, well, then you have to decide if you're going to pay up or not, because these kinds of moves can continue. There is no ABCD structure in place, so right now you still have an A to B point going on. The one that was in place really was extended, had already completed. So right now, wherever that comes back to, let's just say it comes back to there, it's going to be a strong potential move to the top side. So that's Citigroup. That's the way it looks right now. If you're waiting on a retrace, you may not get it. You may have to, try to push in a little bit higher than you want to, or at least start, pushing in if you want to get it involved. I want to talk about, as a spotlight tonight, I want to talk about something that, it doesn't get a lot of press, but it probably should get more. I've seen some writings about it, off and on here and there. And what it is it's stock buybacks. And so, I'm just going to put up some facts, from some various sources that I've read. A lot of this is Wall Street Journal. Corporations last year, or actually in the first half of this year, they bought about $338 billion worth of their own stock. It's the most for any 6-month period since 2007. Now, we know what was happening in 2007. We were topping, basically. And that's according to this firm. 740 firms have authorized repurchase. That's the most since 2008. I'm not trying to scare you. I'm just saying, hey, there's a lot of corporations buying a lot of stock. The growth in the buybacks comes as overall stock market volume has slumped. So we actually have, if you've seen on these charts, more and more the volumes involved in this run-up, they're not increasing for the most part, right? I mean, if we go back to 2010, for example, we were doing, over $1 billion. Now what are we doing? On average, we're doing 700, 800 million. So you have a decrease in the volume at the same time that the stock buybacks are increasing in terms of size. Well, what does that do? It magnifies their effect, right? It makes it bigger than it was. And so, the numbers, if I buy X amount and I buy it in a market where Y is the volume, and then I buy the same X, which I'm not, I'm actually buying X plus, and now the Y is Y minus, it's going to be magnified, and that's what's happening. And so as we see that, 25% of all the non-electronic trades executed, buying back shares, folks. And let's pop up the next one here. So according to Barclays, right, the companies in the second quarter, they spent 31% of their cash flow on buybacks. That's the most since 2008. It's up 14% since the bottom at 2009. It's a pretty big jump. In the end of the second quarter, the non-financial companies, right, they held 1.35 million in cash, down from the 1.4. What is that? Well, they're spending that money on stock buybacks for the most part. Finally, the virtuous circle that usually takes place in an economic recovery, which is investment leading growth, it still isn't happening. Right? We're not seeing companies go out and buy new plants or build new plants, buy new equipment. What are they doing? Well, they're repairing what they have, and they're taking that excess cash and they're turning it into stock buybacks. And a lot of that cash is mostly centered in the large corporations, right? And we wonder, okay, why is the NASDAQ composite, the S&P, the Dow, why are those doing better than the small caps? Well, because they're buying back stocks. I think that's the major difference between those. Some of it, can be factored to other things, but that's one huge difference between those two classes of stocks. Large corporations can issue debt and they can buy stock. Now, why would they issue it if they have all this cash? Well, a lot of that cash is captured overseas and hasn't been repatriated. As long as the Fed practices ZIRP, which is the zero interest rate policy, corporations, it makes sense to borrow at 1.5% or 2% or whatever they're paying, right? Issue that debt and then turn around and buy back their own stock and raise their price earnings, their earnings per share price. In other words, if you reduce the number of outstanding shares, the price of your stock, all other things being equal, is going to go up. And that's what we keep seeing, and that is a large part of one of these anomalies associated with the Federal Reserve doing what they're doing with the zero interest rate policy. It will come to an end. There's no sign of it coming to an end yet, but there will be an end to it. And when it is, it's going to be an issue. And so when you hear of interest rates going up, typically, there used to be an old saying that when the Fed starts raising, you don't worry until it raises the third time, right? That may be true this time as well, and it may not. And it depends on how much they raise by and how much it affects this practice that's going on. If it turns out that they raised, 0.5% the first move, and the corporations can't come out and issue debt at 2%, but now they need it at 3 instead of 2.5%, it might make this very unprofitable or less profitable, and it may start shutting it down. So when those interest rates do finally start to edge up, one of the things we're going to want to watch is the bond issuance by these companies and what kind of rates they're having to pay. And that's going to be a big piece of how these markets react, because right now the majority of the money made is made on the same amount of sells or even less. And that, when it's less, for in particular, that's a result of these big buybacks that keep happening. Either you have to make more money per item that you sell, or you have to find another way to engineer it. And that's that financial engineering that's going on. So something to watch, something to think about. That's the spotlight tonight. And I'm going to leave it at that. It's going to be probably an uneventful week. I would think we just kind of grind around with a bias to the upside as we have done. Have yourself a great night, great weekend, hopefully, and I will see you as the week gets going. Take care. Thanks.